All right, again, hello everybody. Happy Friday to you all. Appreciate you guys taking time out of your schedule here to join us for our options demo today. Want this to be interactive, so if you have any questions at any point during the session today, feel free to type those into the chat box. I will go ahead and keep an eye on that, make sure we get you those answers that you're looking for. The goal of today is to give you a feel for how we approach the markets at NetPicks, specifically with our swing trading of options. I'm going to walk you through some of our recent trades here over the past couple of weeks. It's been a very active stretch for us. The market has really come to life over the past couple of months, and we've actually seen some decent moves in both directions, and that's ideally what we want. We can work with those long-term trends that develop. It's just more difficult. I would rather have the back and forth movement over time, and that's what we've had over the past couple of months. And with all of the uncertainty in the world here at the moment, I just don't see that changing anytime soon. So I see the rest of this year being very active. Next week being a holiday week, being that the markets close on Wednesday because of the 4th of July holiday, that's always the trickiest week of the year for me, at least, because it's right smack dab in the middle of the year. We got the holiday right in the middle of the week. Volume tends to dry up. That's a very prime time for vacation season. So we'll most likely have lower volume here next week. However, the wild card, we've had so many headlines hit the wire here over the past couple of weeks. I mean, we could certainly see an active week next week if things continue to escalate with China, and now news out of Canada here today. I mean, it could certainly be more of an active week than what we're used to around the 4th of July. So all that to say, I'm excited about the rest of the year. I think we're going to have really good conditions to trade in, and we'll talk about that more here over the next hour or so. Before we get into some of our recent trades, I want to give you just some quick thoughts on what I'm looking for here in the overall market going into next week, going into the month of July. Looking at this daily chart, this is just a very simple daily chart of SPY, which is the S&P 500 ETF. I do like to trade SPY, however, I don't use this daily chart to time my entries and exits. I like to use this daily time frame just to get some general thoughts on the markets, get an idea of the pulse of this market. When you take a look at this daily chart here, you can see, I mean, we've had some swings back and forth over the past couple of months. Right? Earlier in the year, we had some pretty big volatility to the downside. We saw a stair-step move back to the upside into the months of April and May and even into early June. We have seen some moves to the downside over the past couple of weeks. However, it's been very difficult on the downside. There's been very little follow-through. When we do get the downside pressure, it happens all at once, right? You get a couple hours of selling, maybe you get a day and a half of selling, and then the dip is bought. It feels like this market's hanging on by a thread. I'm not saying it can't move higher from here. It very much feels like the pressure is building on the downside. And if that explodes, if we start to break to the downside, it could really intensify quickly. I'm not saying it's going to happen here going into next week or even into the middle of July. It could potentially be later in the year, but I do see the volatility picking up. I do see the ranges expanding in this market, and that would be an ideal scenario for us on the option side. In the near term going into next week, you'll notice at the high of the session today, we did get up and touch that solid green line on my chart. That's the 20-period moving average. No surprise that price action stalled out right there. We do have some overhead resistance with those 20-period moving averages. I have both the simple and the exponential moving averages shown there. Those will be areas of resistance that I'll be tracking going into next week. And with any of these moving averages that I have on the chart, a test of them intraday or a break of those levels intraday is not enough. I want to see a close above those levels if this market's really going to move to the upside. On the downside, you can see we do have a cluster of moving averages just below us, but the more important ones that I'm looking at are the 200-period moving averages. Those are the red lines down further, right around the 265 and then the 266.50 levels. I want to see those levels tested again, and I do believe it will happen sooner rather than later. I really want to see how the market reacts to those. So far, anytime that we've touched those levels here this year, it's been a significant bounce off of them. If we break those, that could certainly signify that there's a significant change in the market environment, and we could be in for a pretty impressive wave to the downside. Into next week, with the volume expected to be light, This week, the volume's been pretty good. I mean, we've had a couple of sessions that have been right around the 100 million share level. That's ideally where I want to be, 80 to 100 million shares. That's the sweet spot on SPY. Even though I don't trade the shares of stock, if I can see the good volume in SPY in the shares of stock, in most cases, when we get over to trade the options with many of the names on our list, we will most likely see good volume there as well. There's very much a correlation there. So I want to see the higher volume. It just makes it easier to trade. We can get filled quicker and at better prices. So that's a good thing. So on the upside into next week, I would say the 273.50 to 274 level, that would be an area of resistance that I'd want to watch on the upside. And then on the downside, the first area of support would be the 271.59 level. You can see the moving average right there. Those are some things that I'll be watching going into next week. The volatility has been pretty active here this week. We're currently sitting just above 15 on the VIX. We actually briefly got up into the 19 handle earlier this week. So what I tell our students all the time, if we can get the VIX in a 16 to 20 range, that's our sweet spot. If we can settle in there, it opens up our playbook. We can use a wider variety of option strategies, but it also typically comes with bigger ranges in the market. Because there's some fear that kicks up when the VIX picks up, it gives us a better environment to trade in. So if we can get back into that range here going into the month of July, that would certainly be a good thing. It is going to get pretty active once we get back from the holiday week next week. We do get into earnings season. Mid-July into the end of the month, we're going to be very active with earnings. Every individual stock out there just about will release their quarterly earnings, and we know those are very big events. They can be catalysts for some big moves overall in the market as a whole. So we'll want to watch that closely. That could potentially be the catalyst that we need to get down and touch those 200-period moving averages like we just talked about. Why do I like to take a look at the market big picture? Because it helps me determine how aggressive I feel comfortable being. We have specific trading systems at NetPicks that tell us the exact entries, the exact targets, the exact stops before we ever get into a trade. So we have everything mapped out for us ahead of time. It's still up to us on the option side to determine, okay, how big of a position size do I want to take? What type of option strategy do I want to use? Do I just want to buy a long call or a long put? Do I want to trade a vertical spread? Do I want to sell a credit spread? What type of strategy do I feel comfortable with given the overall environment for the market? So I like to look at that daily chart just so I can get a feel for the overall environment. And that really helps me when I get over to the charts, which we're going to take a look at now. When I start to get these setups on the charts, it becomes much easier for me to determine, okay, how much risk am I going to take here? What type of strategy am I going to use? It's very beneficial. Instead of basing my decision off of emotion and based off of a hunch, I want to base my decisions off of chart patterns, off of numbers and statistics. And that's a big missing piece for a lot of retail traders. I talk to people on a daily basis that are just struggling to hit their trading goals. And a big reason for that is they have no defined system in place guiding them. They're basing their decisions off of a hunch. They're basing their decisions based off of what they're hearing on financial media, so CNBC, Bloomberg, Fox Business. The problem there is everybody has an agenda. So if I take a look, I have a chart of Caterpillar up. I could hear an analyst come on. I could have a hedge fund manager come on CNBC and start to talk up Caterpillar. The problem is you don't know what the basis is for their research. You don't know what type of position they have on if they are a hedge fund guy. Right? So you really don't know what they're saying on Caterpillar, how that impacts their own personal trading or their own hedge funds trading. I think that's very difficult. What I want you to do is have a system in place that gives you a very specific rule set that's going to guide you from start to finish. Doesn't guarantee that you're going to win on every trade. There's no perfect approach out there. And the key is long term, I want to make sure that I'm winning more than I'm losing. So I need to have a good winning percentage, and I need to make sure that my winners are larger than the losers. That's the key formula for successful trading long term. One of the systems that we use to help us with that aspect, what you're looking at on the chart is our Spotlight Power Trader system. On this chart, you're going to see a couple of indicators down at the bottom, and then you're going to see all of these pink dots on the charts. What we've done is we've created what we call our trade calculator. we have taken all of the criteria that we look for in a setup and we've programmed it into that trade calculator. So when all of that criteria is met, we're going to have the entry, the targets, and the stops all outlined for us in real time. It takes the guesswork out of the equation. Right? If I were to pull everybody in here, my guess would be one of the biggest topics that people are looking for more guidance on is knowing when to get in and when to get out of a trade. More importantly, when to get out, because once you're in a trade, you know, it's if you don't have a plan in place, it's easy to base your decision off of emotion. So the minute you're in a profit or a loss, it's natural to want to get out, right? Well, with this chart of Caterpillar, you can see that I have the pink dots on the chart. The pink dots, the first series of pink dots, the ones that I'm circling right there, that was my entry point. This setup initially printed for us back on June 13th, and it gave us an entry point at 153.45. You can see that in my data box on the left-hand side of the platform. So in that data box, you're going to see an entry point, you're going to see my target levels, and you're going to see my stop. So when that trade triggered in, it initially printed for us on June 13th. It did not trigger in until the next day. This is a true swing trading approach. This is not an approach where we're in and out in a period of minutes or hours. This is a true swing trading approach where we're looking to be in for anywhere from 5 days on out to 2 or 3 weeks. That's very typical for us. So once we triggered short, once that entry point was hit, again, there's no guesswork. As soon as that entry point is hit, I know it's time to put my position on. And I know I need to lean bearish. I need to put on some type of a bearish option position. So I came in and I bought the July 155 puts, and I paid $5.30 or $530 per contract. That gave me control of 100 shares of Caterpillar stock on the downside. So I was looking for Caterpillar to move lower. So it wasn't me just guessing or hoping that Caterpillar moved lower. It was very much a pattern that we were identifying on the charts through our Spotlight Power Trader indicators. Once I put my trade on, my focus shifted to my targets and stops. So as price action started to move lower here, it's natural. If I didn't have those dots in place guiding me, it's natural to, you know, once I hit this red candle right here that I'm highlighting, it's natural to probably want to get out of the trade at that point. I've got a nice profit. Let's go ahead and book the profit and not give it all back if price action starts to bounce higher. However, at that point, I had not hit a target level yet, so there's no reason for me to close out of the position. As I started to move lower, notice how my stop dots, initially my stop was all the way up here at this series of pink dots up here. Notice how as I started to go down into profit, those stop dots started to move down. Now all of a sudden they start to move down in a stair-step fashion. As we start to move the stop down, I'm reducing my risk. I'm starting to lock in a little bit of profit. It makes it a much easier trade to hold on to when you're booking profit along the way. Again, we're trying to minimize that emotional aspect of trading that holds so many people back. Well, notice I have different target levels on the chart. Okay, and I'm going to focus your attention on this pink dot here down around the 139.67 level. That is our second target. That's our full target. When I put this position on, I really ideally like to have multiple contracts or multiple spreads if you're trading vertical spreads, because I want to have the ability to peel some of my position off at a fixed target, book the profit, and then keep part of my position on going for the home run trade. Now, we don't always hit the full second targets, but remember, even if I don't hit the second target, along the way as I start to go into profit, my stops move down. So I'm starting to lock in profit very quickly. Well, fortunately on Caterpillar, you know, as the trade war situation, as the issue with China starts to pick up, you know, some of these names like John Deere and Caterpillar and many of the Dow names got hit. They got hit on the downside. We came down and we hit that full second target, and that came on June 21st. So it came about a week later. Once I hit that second target, I closed out of half of my position and booked the profit. And I sold it out for 16 bucks. It gave me just over $1,000 of profit. That's a 200% return in about a week's time. Now, it's a phenomenal trade. I wasn't expecting it to make this big of a move to the downside this quickly, but it did. Again, there's no guesswork there. Everything is outlined for me. Now, I still have the second half of my trade on because, again, anything can happen. What if more news hits over the weekend or early next week that things are not improving with China? This whole trade war is going to escalate even further, and Caterpillar continues to move to the downside. Well, I still have the second half of my trade on. I am starting to move the stop down. The stop is now at 147.94. So I've got a small portion of my trade still on, going for the bigger winner. Worst case scenario, I'm out with a partial profit here. So again, there's no guesswork involved. It's all based off of price patterns. It's based off of price action on the charts. I have no control over what Caterpillar is going to do from day to day. All I can control is my position size and executing my system correctly, and that's exactly what we've done. So, over the past week and a half, to see a 200% return, that's a home run trade. You're talking about $1,000 of profit per contract. That's a nice little supplemental income. I mean, for some people, depending on your position size, it's enough to potentially replace an income on one trade. Now, I should have pointed this out. Some of you might be wondering, okay, what type of chart is this? This is actually a 195-minute chart. Why did I come up with the 195-minute? Because it essentially gives me 2 candles a day instead of 1. The problem I have with a daily time frame is it's a slow time frame. It takes a lot of movement, a lot of follow through to get those trades to work. It's a slower moving chart. So to speed things up a little bit, I go to the 195-minute time frame. It gives me those 2 candles a day instead of 1. It gives me more frequency of trades. It allows me to react faster to changes in stock price. And I have found really good results with that 195-minute. So really nice trade there on Caterpillar, no doubt about it. If I switch on over here to Boeing, symbol BA, this is a trade that is currently in progress. So this is another short trade. You can see the pink dots here on the chart. You can see where my crosshairs are pointing at. This setup printed back on June 14th. Entry point was there at 358.33. Now I came in and I bought the July 360 puts for $10.20, so just over $1,000 per contract. This trade did not trigger in until the next day, so I had a full 24 hours to identify the trade, get my trade ready to go. So it's not something where you've got to sit there from opening and closing bell waiting for trades to print and trigger in. We can come in a couple times a day, check the charts, make sure that we're able to catch the trades as they come, get our orders in place ahead of time, and then move on with our day. So if you've got to get back to a full-time job or other family commitments, you can do so very easily. Now, at over $1,000 a contract, I understand that's pretty expensive. You could also take this with a put spread. The way that we teach trading vertical spreads to our students, following our criteria, you typically see a 30 to 50% cost savings. So it's significant. That's one way of doing it. And then I'm going to show you here in just a bit how selling vertical spreads to open up a trade can actually reduce your cost even further. So that's the great part about trading options. There's always something that you can do to stay active regardless of your account size. It's easier to control your risk with options than any other market out there, in my opinion. So once we came in and we bought the July 360 puts, my focus shifted, just like on Caterpillar, down to my targets and my stop. My stop was up here at the pink dots up above, and you can see my different target levels down below. As I started to hit target levels, I started to move my stop down. So my stop came down to the first level right here. And notice how we continue, as we continue to move to the downside, that stop continues to move down along the way. So I'm locking in a profit. Worst case scenario, I'm out with a partial profit here. Now, when you look at this chart, I mean, certainly Boeing has made a nice move to the downside. Why wouldn't I just close out of the trade now, book the profit, and move on to the next trade? Well, because I have not hit a stop or a target yet. But I have to stay disciplined to my system. I like to give this trade a little bit of room to breathe. I don't just move my stop, very close to the current stock price, because I have to give it room. I don't want to get stuck in chop. I don't want to get whipped around all the time. I want to give this trade room to breathe just in case it's going to continue to move to the downside here in the next couple of weeks. At the time that I marked up this chart here earlier this morning, the puts were trading for right around $22.65, so I had about a $1,200 profit, or 122% return. Obviously the market's moved higher here today, so it may be trading for less than that now. But I still have my full position on. If we can get down and hit my full target, it's all the way down at 304.62. So I still need a significant move to the downside to hit my full target. But the beauty here is I continue to move lower. My stop is going to continue to move lower. I'm going to continue to lock in more and more profit every single day. So it's a good position to be in. Okay, just a really nice profitable position. And here too, if we start to hit some of these other targets here, the first two pink dots that I'm circling there, those are money management targets. If you're trading multiple contracts, let's say you get into this position with 4 or 5 contracts, if you start to hit that first or second target, I have no problem peeling part of your position off. Maybe you take one contract off that first target, at that money management target. Block in a little bit of profit there. There's certainly things that you can do as you start to trade larger position sizes. So just a really great trade there on Boeing. And the beauty here is the system doesn't change. It's the same criteria. It's the same indicator set. It's the same chart time frame. This is still a 195-minute chart. So it just makes it so much easier to come in and work through a whole watch list of products when you're using the same system and the same rule set on the same products day in and day out. If I take a look at John Deere, symbol DE, this is another short trade that we just wrapped up here earlier this week. So this is another one that triggered it on the downside. And the reason I know it was a short trade, I'm seeing the pink dots there on the chart that printed back on June 13th. The trade didn't trigger in, okay, till later on that afternoon. It triggered short. I came in and I bought the July 160 puts. I paid $760 per contract. We continue to move to the downside. My full target, which is this pink dot right there, my full target was at 141.79, and that level was hit. We did end up hitting that second target. I closed out of half of my position, booked at an $1,100 profit, 147% return. We're in and out in less than a week's time. That's ideal for me. I mean, that's phenomenal. And when you start to combine that with trades on Boeing and Caterpillar, on just 3 names, these are names that we trade consistently week in and week out. There's a lot of profit potential there, right? And we're doing this in about 20 minutes a day or less. That's a great way, to generate some income without a huge time commitment and without a huge account size. We're talking in this case here less than $800 per contract. And then I kept the second half of my trade on with a trailing stop, and that level ended up getting hit here back on Wednesday of this week. You can see price action got up and touched that trailing stop, so I ended up getting taken out of the second half of my trade, still with a phenomenal profit, and now we're flat. We're in a wait and see mode here. I just have to wait for the next setup to print for us. So I don't see any dots on the far right edge of the chart. This is why I love having a system in place like this. A lot of times, I will get on Twitter or Facebook over the weekend, and I'll notice that traders are just spending hours and hours over the weekend trying to find chart patterns for the next week, trying to find that next hot name for the following week. Well, my schedule doesn't always allow me to do that, nor do I have a desire to do that day in and day out, week in and week out. What I like to do is to look at the same consistent watch list of products all the time. It cuts down on the time commitment that's required. It also allows me to get to know the products on my list really well. I'm not just pulling up a random stock off of a piece of scanning software. I'm looking at the same names, the same list of stocks and ETFs day in and day out, and that's a huge advantage long term. If I take a look at John Deere, this is live price action on the right edge of the chart. Going into next week, I don't see a series of pink dots. I don't see any setup dots. On the current candle that's forming, there's no setup there on the chart. There's no entry points printing on the chart. I don't need to spend all weekend there trying to justify whether I take a new position on John Deere or not. Everything's outlined for me. If there's no setup there, I'm not going to force it. It's tempting when you come off a winning trade. It's natural to want to say, okay, let's jump right back in something else. John Deere's been good to us. Let's stay active on it. Well, if there's no setup there on the chart, it's not a guessing game. It's either a setup or it's not, and at the moment there's no setup there. So I'm just in a wait and see mode going into next week. Now, looking at these Spotlight Power Trader charts, I love trading this system. It's been very, very good to us, produced some really phenomenal profits here of late. However, it is a slower moving system. We're going to, over time, have longer holding times. We had a position here a couple weeks ago that we were talking about with our students. We were actually in that trade for about a month and a half. Some people might be okay with that. Some people might just need more action. You need more activity. It's difficult to stay in an option position for a month and a half. Fully understand that. So the other system that I like to use in my own personal trading is what we call our options fast track program. And let me switch over there here right now. So the options fast track, it's a different set of indicators. We're looking for a different sequence in our trades. However, at NetPicks, we're very big believers in having these trade calculators that are plotting the entries, the targets, and the stops for us in real time, because we don't want that guesswork to be there. So even though we're looking for a very different sequence in these trades, everything is still outlined for us in real time. The difference here, the reason why I like to mix the two approaches, the Spotlight Power Trader charts, which we just took a look at, they're slower moving trades, you're in the positions longer. The options fast track charts have shorter holding times. We're typically looking for smaller trade profiles, and some people might just like that better. I like to have a mix of both. I'm a big believer in having different layers of diversification in our trading. So here on Facebook, the difference now between these two chart types, we looked at the daily, the 195-minute charts with the Spotlight system. If you take a look at Facebook, I am now looking at a range chart of $1.45 or 145 ticks. What that means for us is that every candle on this chart represents $1.45 of price action from high to low. It has nothing to do with time. It could take 2 minutes for a candle to form. It could take 2 days for a candle to form. It takes our focus off of time and focuses it exclusively on price action. That allows me to react much faster. If price action starts to get busy, starts to get active, we're going to have more candles throughout the day on a range-based chart. It's going to allow me to get in and out of trades faster. If the market really slows down, the range charts are not forced to print candles. That 195-minute chart that we took a look at here a few moments ago, it has to print a candle every 195 minutes regardless of how active the market is. So those charts, if the market gets choppy and slow, those charts can get pretty ugly at times. The range-based charts will have a smoother overall look and feel because they're focused exclusively on price. It identifies the best moves because we're focused solely on price. Now, how did I come up with the $1.45? There's a formula that we look at once a quarter that tells us the exact range setting that we should use on every product on our list. That way, again, there's no guesswork. It allows us to fine-tune the system every name on our list. If I take a look at Facebook and Bank of America, two very different products. A $1.45 move on Facebook is completely different than a $1.45 move on Bank of America. So I want to take a look, use that formula once a quarter to determine the exact range setting for every name on our list. It's a huge advantage long term. So we had this short trade that came back on June 21st. So this is just the last short trade that was closed out here. It gave us an entry point at 199.99. I came in and I bought the July 202.5 puts, paid $630 per contract for that put option. We triggered into this trade on the 22nd, so it's set up for us on the 21st. We triggered in the following day. We were already out of this trade on the 25th. We're in and out in just a couple of days. It's very quick. It's a smaller profile trade when compared to the Spotlight Power Trader charts. Still gave us a really nice return, gave me a $330 profit, 53% return, and everything, again, is outlined for me in real time. Once I triggered into the trade, my stop was up here at the upper series of pink dots. Once I started to move down into profit, once I hit that first target, the stop goes down to the entry point. It goes down to break even. So I'm taking the risk off the trade at that point. If you're trading multiple contracts, you could take half of your position off at the first target. I have no problem with that. In fact, that's something I do in my own personal trading. And then fortunately for us, didn't matter. The stop didn't come into play because we hit the full target. The reason I'm able to get in and out in 20 minutes a day, check my trades, check my charts, be active in the markets, is because the calculator is doing all the hard lifting for me. It's doing all the calculations for me. It allows me to focus in on properly managing my risk, executing my system correctly. So when I come in, it's not going to do all the work for me. I still have to manually come in, place the trade, move my stop, and when I say move the stop, the calculator is going to move that dot on the chart for me. What it's not going to do is automatically adjust an order, for example. That's still something I have to come in and do myself. So just a really phenomenal trade there on Facebook. Let's move on over to Google. I want to show you Google here because I want to show you a vertical spread. A lot of times people shy away from these higher price stocks because they just think, hey, with a smaller account size, I can't afford to trade Google and Amazon. Well, maybe you can. If you utilize some different option strategies, there's ways that we can reduce that risk considerably. If I just come in and buy an outright call or a put option on Google, you're potentially talking about $2,500, $3,000 per contract. It can be very expensive. Well, let's talk about how we can reduce that risk by going to a put spread. Here's a short trade. This is the last trade that we closed out on Google. It triggered short at 1170.67, the first series of pink dots right there. Why was that a setup? Why did the entry point print right there? This is our reversal trade. I'm looking for overbought or oversold market conditions. In this case, we got overbought. The reason I know that is because the percent R indicator down at the bottom got up above -10. The percent R indicator is a very common indicator in most charting platforms. We do use some custom settings inside of it to really be picky on what's overbought and what's oversold. When I got above -10 here on percent R, it had me looking for a pullback. It had me looking for a reversal to the downside. I don't just immediately jump into a trade because I know, and we all know, overbought or oversold can stay that way for longer than any of us expect. So I have to wait for confirmation, and that's why we use that solid white line on the chart. That's what we call our signal line. Step number 2 in a trade is I need to close below my signal line, which we got right here on this candle that my crosshairs are sitting over. As soon as we get a close below that signal line, the calculator knows how to read that. That's when it prints the setup for me. That's when it gives me my entry, my targets, and my stop. Instead of just buying an outright put like we did on Facebook and like we did on Caterpillar and John Deere, I came in and I bought the July 1172.5, 1137.5 put spread. What that means there is I'm buying the 1172.5 put, and at the same time, I'm selling the 1137.5 put to put me into a vertical spread. By buying and selling a different contract here, it allows me to reduce the cost of the trade. And I paid just under $1,400 per spread. I get it, it's still expensive, but when you compare it to the $3,000 price tag of just buying the outright put, that's a significant savings there. The put spread, a lot of times people shy away because they think they're advanced or they're riskier. They're actually not. The put spread is still a risk-defying trade. Whatever I pay for that spread is the most I can lose on the position, regardless of what happens. If I'm dead wrong on Google and it doesn't move lower, let's say it moves higher by a couple $100, the most I can lose is whatever I pay for that spread. Now, fortunately for us, you can see price action did move to the downside, so the stop never came into play. We hit the first target. As soon as the first target was hit, we moved the stop down to break even. And then ultimately, we hit the full second target, and I sold out of the position, booked a $660 profit. It's a 48% return. So what you'll notice with a vertical spread, you will never hear me complain about a 50% return, a 48% return in a matter of a couple days. We are in and out of that trade in 2.5 days. A 50% return in 2.5 days, I am thrilled with that. But it is going to be a smaller return when compared to the long put positions that we took over on Caterpillar or John Deere or Boeing. It's a more conservative trade. You're going to have smaller profit potential along with smaller risk. And in many cases, that's a fair trade-off. When you start to trade some of those higher price stocks, I'm perfectly fine with the vertical spread. Giving up my home run profit potential in exchange for less risk, that's a no-brainer in many cases. So just a really phenomenal return there on Google. Now let me show you an outlier move. It was a really nice trade on QQQ, but I want to show you how the range-based charts at times can be very quick. Here's a trade on QQQ. This one initially set up for us. First thing, actually end of last week is when it initially set up for us. It did trigger in first thing Monday morning right here on this red candle. So again, we had an overbought condition on percent R. I had a candle close below my signal line that gave me the entry point. We had all weekend. It started to set up for us on Friday. We had all weekend to get the trade ready to go, and first thing Monday morning, it triggered short. It was a phenomenal move to the downside, but it happened immediately. Already by Monday afternoon, we had hit the full second target. Now, we were able to book a $238 profit, a 67% return, because we bought the 175 puts. We paid $356 for them. And that afternoon, that same day, we were able to close it out for that $238 profit. It's not ideal, and the reason I say that, why am I complaining about a full profit? I'm really not. It was an extremely fast trade, and they will happen from time to time. What I pointed out to our students this week, you have to put into context what happened on Monday. We had the NASDAQ down over 200 points midday. That is not typical. Does not happen very often at all. So it's an outlier move. In most cases, in most trades, we're in and out in about 3 to 5 days. That's a very typical holding time. We will certainly have some outlier moves from time to time. I mentioned a few moments ago, we had a trade that went on for a month and a half. Here's a case where it trades in and out in a period of a couple of hours. So they don't happen very often, but it is possible. So just a really nice trade there on QQQ. And now we do have a new long setting up here going into next week. I mean, so far all the trades that we talked about are on the downside. Do we only play the downside? Well, that's not the case at all. It just happens to be here. I'm showing you recent trades that were closed out within the past week or so. And during that time, we've had some selling pressures. That just happens to be, what we've been dealing with lately. But if the market moves to the upside, we can work with that as well. Going into next week, the NASDAQ here on QQQ has a long setting up. The system is giving us a long setup at 172.95. Now, price action hasn't gotten up to touch that entry point yet. It came close here earlier today, but it did not officially hit it. If we get up and touch that entry point, I would go ahead and buy some call options there, or you could buy a call spread. Certainly valid either way. We just need to make sure that we're in a bullish position if that entry point is hit. So now my plan for the rest of today, my plan for Monday is already set in stone for QQQ. I don't need to sit there and spend a ton of time over the weekend evaluating things because everything's outlined for me on the charts. It's a huge advantage long term. Now, in fairness, I would love to tell you that everything is going to work all the time and you're just going to have winning trades all the time. It's just not the case. We know that's not realistic. Let's take a look. Let's take a look at a long setup on Goldman Sachs that did not work. I've had a phenomenal week this week. It's been a very profitable week. During the last week, I've had winners, losers, and break-evens. That's part of trading. I'm not looking for perfection. If you're properly diversified, you are going to have winners and losers along the way because you never want to load the boat and be 100% long or 100% short at the same time. Because if you get on the wrong side of that move, you're 100% long and the market sells off, you're going to face a large drawdown on your account. So ideally, I want a mix of long and short trades. Just so happens here on Goldman Sachs that we triggered into a long trade. That happened here on Friday of last week. You can see we had an oversold condition on %R down at the bottom. We got down below -90. I had a candle close above my signal line. That gave me the long entry point. We did trigger into the long, and almost immediately, within a day, I had stopped out. Now, when that stop is hit, it's the most difficult thing to do is to take the trade off. Because in this case, my opinion, my outlook hadn't changed. I still wanted Goldman Sachs to move to the upside. The option still had time left before expiration. I could have held the trade longer. But by respecting the system, taking the trade off at that stop, I prevent myself from taking 100% loser. When I took the loss there, it was a partial loss. In most cases, our losing trades are going to be in the 20 to 40% range. So they're going to be smaller than our winners. That's by design. I don't want to have one losing trade wipe out 3 or 4 winners. Very difficult to handle that psychologically long term if you get into that rut. So by respecting the system, getting out at the stop, I'm keeping my loss as small as possible. Because I'm able to do that, I'm still having a great week because I know I'm going to win more often than I lose. All right, but what happens if the market is not moving? I mean, so far we're talking about directional trades that have worked out in our favor. So buying puts on some of these names it's worked out really well. I mean, we're talking about thousands of dollars of profit. What happens if the market is not always making those big moves? I love to buy calls and puts. It's a big part of what I do on a daily basis. Those types of trades are going to give me the higher profit potential, but they also come with a higher amount of risk. The only way I make money if I buy a long put option is if that stock moves to the downside, and it does so quickly. If we just chop around sideways, if the market starts to reverse back to the upside, I can't make money from that. So I have one way of making money, but if that one way works out, I've got a big profit potential. So it's great. However, there's other ways that I can start to build in different layers of diversification. Let's take a look at a chart of Netflix. This is a trade that we sent out to our Options Express members, and our Options Express program is actually a signal service. We send out between 3 and 10 trades each week through text message, through email, and in our private Slack group. That way, when it's time to place a trade, you're going to have exact instructions on what trade we're taking, what price are we looking to get filled at. When it's time to close out of the position, we also send out those alerts. And so it's a great way to stay active in the markets without a huge time commitment. So what we looked at on Netflix, when we put this trade on a couple weeks ago, the market had made an impressive run to the upside. I mean, Netflix has been one of the strongest names in the market now for months. We were at an overbought condition. We had just got done making new all-time highs, and we said, okay, let's go ahead. The market's overdone here. Let's go ahead and sell a call spread. So we came in and we sold the 405, 410 call spread, and we collected $1.37 or $137 per spread. What that means is I'm selling the 405 call, and at the same time I'm buying the 410 call to make it a risk-defined trade. A lot of times people get intimidated by selling options to open up a trade because they think it's really risky. It's actually not. It's a fully risk-defined trade, just like it would be if you buy a call or a put. Yeah, it tied up $363 of capital per spread. If you take a look at buying a put option on Netflix, the problem there is you're going to spend a couple $1,000s to buy a put option. And by buying a put option, you only make money if Netflix moves lower. Well, I wanted to lean bearish on Netflix. I was just a little less certain. I wanted to be more conservative because I thought, hey, we're overbought here. It may not turn immediately. We may just kind of chop sideways for a stretch. By selling the call spread, it actually gives me 5 ways of making money on the trade. Because I collected $1.37, it put my break-even point at 406.37, and I marked that with that horizontal white line. As long as price action stayed below that level, I can make money. So if it moves up, down, or sideways, I make money. I make money from time decay adding up and from volatility decreasing. So I give myself 5 ways of making money on the trade. I lose out on the home run profit potential that I would have by buying the long put, but in exchange, I give myself multiple ways of making money and a higher probability of success. Look at this chart of Netflix. When we put this trade on, we were dead wrong initially. It actually moved above our break-even point, and we were underwater. We were losing money there for a 3-day stretch. Price action did reverse back to the downside. It hasn't been the cleanest pattern. I mean, there's some choppy noise kicking in there on Netflix, correct? But remember, when I sell a call spread, I don't need a big move lower. All I need price action to do is stay below 406.37. If it does, even if it does so by 10 cents, I get to make money on the trade. We closed this trade out here earlier this week, closed it out for 52 cents. It gave me an $85 profit, which at initial glance, I mean, that doesn't look as attractive as the $1,000 of profit that we had on Caterpillar, right? But remember, I only tied up $360 of capital to begin with. I gave myself 5 ways of making money on the trade, and I really didn't get a huge move to the downside, and I still made money. I was essentially dead wrong. Netflix, I mean, really hasn't fallen apart like we wanted it to, but I was still able to make money on the trade. Maybe you don't have $2,000, $3,000 to buy a call or a put on Netflix. Maybe you can afford to put $360 into selling a call spread. It's still going to give you a nice potential return there, even if you're not quite right on the directional move on the stock. It's just a more forgiving type of trade. Here's Twitter. We took a very similar approach on Twitter. Twitter's another extremely strong name right now. It's been phenomenal. I mean, you can see on this daily chart, I mean, it's just been a straight shot to the moon here. What we did is we sold the 47.5, 48.5 call spread. So it was a dollar-wide spread. We collected 34 cents or $34 per spread. The best part about this trade is it tied up $66 of capital. So if you've got that smaller account size, if you're saying, okay, Mike, the results that you've shown so far, they're attractive, but I can't afford to put $600, $1,000 into one position. Well, here's a trade that you can take for $66 per spread. Right? And that's what we do with many of our options express trades. A majority of our trades are taken with less than $100 of risk. If you've got a bigger account size, sure, you can trade this with 10, 20, 30 contracts or 30 spreads. You could take it with 10 spreads and only have $660 worth of risk. So when we sold this spread, it put my break-even point at 47.84. I put that solid white line on the chart. I didn't care if Twitter moved up, down, or sideways. As long as it stayed below that level, I got to make money. This very much like Netflix. Have we started to see Twitter roll over a little bit? Sure. It's been a very similar pattern market-wide. We've seen some names look a little nervous. There's been very few that have actually, really taken a hit. We've seen names like Caterpillar and John Deere that have taken a hit, but there's a lot of tech names that are just they're hanging on by a thread here on Twitter. We didn't get a big move to the downside, but I didn't need it to. We ended up closing this spread out for 7 cents. It gave me a $27 profit, which again, doesn't seem like a huge profit. Remember, I only tied up $66 of capital to begin with. If you put it on 10 times, with less than $700 of risk, now you've got almost a $300 profit. And this trade was in and out in a matter of a couple of days. Okay, I still had the 5 ways of making money on the trade, so up, down, or sideways. As long as price action stayed below my break-even point, I made money. I made money from the time decay adding up and from the volatility decreasing. So I still gave myself 5 ways of making money. The only move that would hurt me here on Twitter is a big move to the upside, which we're already overbought. The market's way overdone on the upside, so I wasn't really worried about that big move higher because the chances of that happening were pretty slim. So it worked out really well for us on Twitter. And then finally on IWM, this is another one where we sold a call spread. IWM out of the index products. IWM is the Russell 2000 ETF, by the way. Out of the index products, the Russell has been by far the most impressive on the upside here over the past couple of months. It got very overbought, so we came in and we sold the 168, 169 call spread. We collected 39 cents or $39 per spread. It only tied up $61 of capital to put the trade on to begin with. So again, we're keeping that risk as small as possible. Gave me a bearish outlook, but it gave me more ways of making money. Just in case we didn't get that immediate move lower, well, I didn't need the immediate move lower. As long as it stayed below 168.39, I got to make money. So we ended up closing this trade out. We booked a $30 profit. Obviously you can see price action has certainly come off of the highs, but we didn't need it to. We didn't get the market to completely fall out of bed. It just hasn't yet. But we didn't need it to by selling the call spread. We were still able to book the profit from just a slight pullback off of the highs. Now, the best part about this style of trading with options, notice what we've done here over the past 45 minutes. We've taken a look at a mix of different individual stocks. We've taken a look at some ETFs. We're looking at products that are in different price points. We've taken a look at a number of different option strategies, some long puts, a put spread. Now we're taking a look at selling some call spreads. There's so much that we can do here to get diversification and to get a better mix in our trading. The better diversification that you have, the better your consistency will be long term. Can you just buy calls and puts and be successful long term? You can. You just have to know that you're going to have bigger swings in your equity curves. When it's going well, there's a lot of money to be made. If the market's not making those big moves, you have the potential there for a deeper drawdown. So when you start to mix these types of approaches, that's when trading starts to get fun, and that's how I generate my full-time income from the markets. So if you're trading futures or you're trading Forex, maybe you're a day trader, it's just a great way to mix up some different approaches. For those of you that have the smaller account size and you feel like you have to trade the penny stocks or you have to trade the binary options, maybe you don't. Okay, I just showed you 2 trades on Twitter and IWM that took less than $100 of capital to put the position on. You're going to give yourself a much higher probability of success by trading options when compared to binary options, when compared to penny stocks, when compared to Forex. You just are. It's easier to control your risk because there's more strategies that we can use. When you trade, if you trade the Forex markets, you're limited to buying or selling a currency pair. That's all you can do. Okay, you can't come in and give yourself 5 ways of making money by selling a call spread like we talked about on IWM. You can't do it. So that's why with a lot of our traders that come our way, that are really struggling, to hit those profitable results, there's two main reasons. Number one, they don't have a system in place that guides them. There's nothing there that they can stay disciplined to. And the second big reason is they're trading the wrong markets. They're trading crappy markets because they have a small account size and they think that that's what they're limited to. What I would challenge you to do is, be open. Take that open mind and say, okay, let's lay everything out on the table. Let's see what is going to give me the best probability of success. Don't look for those instant home run trades. Don't look for the instant riches. Look for something that's going to set you up for long-term success. If you can take that long-term mindset, there's a lot of profit to be made here in the markets. I've told this story a lot of times when I've spoken in these webinars in the past. I started out as a day trader, and I was convinced that day trading futures was the way to go for me. And I had so-so success. It was very streaky at best. And what I found is I was struggling because it was difficult for me to make split-second decisions. That's not my personality. I tend to be an overanalyzer. I tend to be a deep thinker. It's difficult for me to make a split-second decision, which is absolutely required to day trade. If you can't make a split-second decision, you're going to find it very difficult to day trade futures. Well, what I found is that, okay, being an overanalyzer, being that slower thinker, by swing trading, it makes more sense. By swing trading with options, it makes more sense because now I can think through trades. Can really process things before I put my hard-earned capital on the line. So now I found my niche. Doesn't mean that you can't make money day trading. There's a lot of successful day traders out there. I just know for me, I don't care how good the results are. A trader could come to me and say, Mike, I'm winning 85% of the time. I'm making thousands of dollars. If that does not fit your personality, if it doesn't fit your risk tolerance, it's going to be very difficult to mimic those types of results. So for me, I ignore what goes on the day trading side. I know it's not for me. I can't do it. My niche is in swing trading options. I don't need to trade futures, forex, stock, options. I don't need to do it. I'm going to find my specialty and focus in there. There's plenty that I can do to stay diversified inside of options exclusively. So be open to different markets. If you're not hitting your desired results, maybe you're in the wrong spot. Unfortunately, it took me way too long to realize that was the case. I mean, it took me a good couple of years to realize that, I just was in the wrong spot. And it's unfortunate that I wasted so much time, but I can't change that. So now that I found my specialty, I found the spot where I can make the consistent returns. That's what I'm going to focus in on. Now, if you have any questions on anything that we've talked about today, if you'd like more details on the systems or on options trading in general, we're not trying to sell you anything today. There's going to be no sales pitch here today. We just wanted to give you an overview of our style of trading, how we approach the options markets, show you some of the results that we've seen here this past week. If you have any questions, feel free to email me directly. Mike@netpicks.com is my email address. I'd be more than willing to set up a call. We can always connect for a phone call and answer any questions you might have and provide you more details and how you can gain access to all the tools that I showed you here today. These are the same systems that I use to generate a full-time income from the markets, and you'll have access to everything. We don't hold anything back. All those indicators that I showed you on the charts today, those are all part of our Inner Circle package, which we'd love to connect and talk through in more detail. Right, so if there's no questions, I don't see any questions here in the chat box. If you've been holding on to a question here, just waiting for me to potentially cover it here in my presentation, go ahead and get it in now, and I'll certainly get you some answers there. Otherwise, I'm going to start to wrap up here for today. Enjoy the rest of your afternoon. Enjoy your weekend, everybody, and then happy 4th of July to you all here coming up next week. We will be back here in a couple of weeks. We'd like to do these every other week, and our next session will be covering the day trading side. Troy, who's one of my colleagues here at NetPicks, he will jump on and talk about how we day trade the futures and the Forex market. So don't see any questions coming in, so I'm going to wrap up here for the day. Again, enjoy your weekend, everybody, and we'll talk to you guys here again soon.